Good morning and welcome to Market Insights. Today, we're diving into a crucial topic for every investor: understanding market bubbles and how to navigate potential crashes, Anna said informatively. Anna introduces the day's topic, setting the stage for a discussion on market bubbles and crashes. Throughout history, financial markets have experienced periods of irrational exuberance, leading to what we call bubbles. These are characterized by asset prices that far exceed their intrinsic value. I'm telling you, Sarah, this tech stock is going to the moon. Everyone's buying it, Mark said, enthusiastic. But Mark, have you looked at their fundamentals? Their profits don't justify the stock price, Sarah replied, cautious. Mark is caught up in the hype while Sarah exercises caution, questioning the stock's true value. This highlights the difference between speculative investing and value investing. Today, we're diving into the turbulent waters of stock market bubbles and the looming threat of a crash. Can we predict these events? And more importantly, how can we manage our risk? The market's been on an unprecedented bull run. Tech stocks are soaring, and new investors are piling in, fueled by social media hype, Anna said, sounding optimistic. That's precisely the problem, Anna. We're seeing classic signs of irrational exuberance. Valuations are detached from reality, and people are ignoring fundamental risks, Mark responded, his tone full of concern. History is filled with market bubbles: the dot-com boom, the housing crisis. Each time, euphoria blinds investors to the underlying dangers. But this time is different, Mark. We have unprecedented technological innovation, low interest rates, and a global economy primed for growth, Anna said confidently. That's what they always say, Anna. Today, we delve into the turbulent world of stock market predictions. Can we foresee a bubble? And more importantly, how can long-term value investing protect your portfolio? I'm seeing red flags everywhere. Tech stocks are overvalued, interest rates are rising, and there's a herd mentality driving prices sky high. It's a classic bubble in the making, Anna said, concerned. Anna pointed out the signs of potential overheating in the market. While I agree there's exuberance in certain sectors, broad statements about an impending crash are premature. Focus on the fundamentals. Are companies generating real profits? Do they have a sustainable competitive advantage? That's what long-term value investing is all about, Mark responded, measured in his tone. Mark offered a more cautious perspective, emphasizing the importance of fundamental analysis. History teaches us that bubbles inevitably burst. Today, we delve into the fascinating yet perilous world of stock market bubbles and the crashes that inevitably follow. What drives these cycles, and can we predict them? Joining us is renowned behavioral economist, Dr. Thomas Ashton, Anna announced. Thank you for having me, Anna, Dr. Ashton said with a professional tone. Curiously, Anna asked, Dr. Ashton, what exactly defines a stock market bubble? A bubble occurs when asset prices deviate significantly from their intrinsic value, driven by irrational exuberance and speculative trading, Dr. Ashton explained. History is riddled with examples, each fueled by a narrative, a belief that this time is different. But is it ever? What role does market psychology play in creating and sustaining these bubbles? Anna asked, her tone questioning. Psychology is paramount. Herd behavior, fear of missing out, FOMO, and cognitive bias. Today, we delve into the fascinating yet perilous world of stock market bubbles and the crashes that inevitably follow. What drives these cycles, and can we predict them? Joining us is renowned behavioral economist, Dr. Thomas Ashton, Anna announced. Thank you for having me, Anna, Dr. Ashton said with a professional tone. Curiously, Anna asked, Dr. Ashton, what exactly defines a stock market bubble? A bubble occurs when asset prices deviate significantly from their intrinsic value, driven by irrational exuberance and speculative trading, Dr. Ashton explained. History is riddled with examples, each fueled by a narrative, a belief that this time is different. But is it ever? What role does market psychology play in creating and sustaining these bubbles? Anna asked, her tone questioning. Psychology is paramount. Herd behavior, fear of missing out, FOMO, and cognitive bias. Today, we're diving deep into the volatile world of stock market bubbles and crashes. Joining us are Anna, a seasoned financial analyst, and Mark, a renowned economist. Let's get their insights on predicting these market phenomena. Thanks for having me. Understanding market psychology is key. We see bubbles inflating when investors become overly optimistic, often ignoring fundamental values, Anna said, analytically. That's right, Anna. Economic indicators might be flashing warning signs, but if the overall sentiment is bullish, those signs are often dismissed, Mark noted, with scholarly insight. The market continues its climb, fueled by speculation and a fear of missing out. But can this continue? Look at the velocity of this growth. It's unsustainable. Historically, these rapid ascents are followed by equally dramatic corrections, Anna warned cautiously. Throughout history, financial markets have been prone to bubbles and crashes. Predicting them, however, is a notoriously difficult task. The market's looking frothy. We're seeing dot-com levels of exuberance, Anna said, concerned. Anna, we've heard this before. Every bull run has its naysayers. Fundamentals are solid, Mark replied, skeptically. Anna predicts a major correction, while Mark remains optimistic about continued growth. Months pass. The market continues its upward trajectory, defying the bubble predictions. Economic indicators send mixed signals, creating further uncertainty. I don't get it. All the signs are there. How can this rally keep going? Anna exclaimed, exasperated. Anna's conviction wavers as the market ignores her warnings. She starts to second-guess her analysis. Patience and discipline are key. Panic selling is the biggest mistake investors can make. Mark, good morning and welcome. Today, we're diving into a topic that's been on everyone's mind: stock market bubbles and crash predictions. Are we headed for a fall? Anna said in an informative tone. Anna introduces the day's topic, setting the stage for a discussion about market instability. For months, experts have been sounding alarms. Some point to inflated valuations in tech, others to rising interest rates. Are these signs of a bubble about to burst? I'm telling you, Sarah, this can't last. It's just like 99 all over again, Mark said, concerned. Come on, Mark, you always say that. This time it's different. The fundamentals are strong, Sarah replied, dismissively. Mark expresses his skepticism about the market's sustainability, while Sarah counters with an optimistic view. Anna asked Dr. Lee inquisitively, Dr. Lee, thank you for joining us. What's your take on... Anna is glued to the screen, concern evident in the air. Come on, rebound, just a little bounce back, Anna said anxiously. Hours pass and Anna's anxiety grows. She can't resist the urge to check the market every few minutes, each update fueling her worry. Is this the start of a crash? Should I sell everything now? Anna asked, panicked. Anna, I understand your concerns. Market volatility is unsettling, but it's also a normal part of investing, David said calmly. But what if it keeps going down? I'm so stressed about losing everything, Anna replied, her voice filled with worry. David reassured her. That's where a long-term strategy comes in. We discussed diversifying your portfolio and setting realistic expectations. Remember? David reminds Anna about the importance of sticking to her investment plan and avoiding impulsive decisions based on short-term market fluctuations. The stock market, a realm of opportunity, but also prone to bubbles. Today, we're diving deep into understanding these bubbles, predicting crashes, and the crucial concept of lost compounding growth. Welcome to Market Insights. Today, we have financial analyst Mark Olson joining us to discuss the risks of stock market bubbles and crashes, Anna said enthusiastically. Mark, welcome to the show. Thanks, Anna. Great to be here, Mark replied professionally. A stock market bubble occurs when asset prices rise far beyond their intrinsic value, fueled by speculation and investor exuberance. Think of the dot-com boom in the late 90s. Companies with little to no revenue saw their stock prices skyrocket, only to come crashing down when reality set in, Mark explained, knowledgeable. So, how can investors identify a potential bubble before it bursts? Anna asked inquisitively. The stock market, a landscape of opportunity and risk. But what happens when speculation turns into a bubble and predictions fuel panic? Good morning, I'm Anna Chen. Today we're diving into the turbulent waters of stock market bubbles, crash predictions, and the misinformation that can drive panic trading, Anna said, seriously. The seeds of a bubble are sown when asset prices detach from their intrinsic value, driven by speculation and hype. Add in predictions of impending doom, amplified by social media, and you have a recipe for disaster. Did you see this article? They're saying the market could crash any day now, Mark said, worried. I know. I'm starting to think I should sell everything before it's too late, Sarah replied, anxious. This is the power of misinformation and fear-mongering. Unverified claims spread like wildfire, influencing